Hello, everyone. Today is the 25th of March 2025, and this is the Just Dario Daily. The title of today's daily is The Bear Market Started, a guide on how to navigate it. Navigating a bear market can be daunting, especially if you are unfamiliar with the signs and strategies to manage your investments during such times. Understanding when a bear market begins, how to trade during its course, and which assets to hold can make a significant difference in protecting your portfolio and making informed decisions. A bear market is typically recognized by a decline of at least 20% in major stock indexes like the S&P 500 or the Dow Jones Industrial Average. However, waiting for such a drop to confirm a bear market might mean it's too late to take preventive action. The first signs often appear when leading stocks start to decline sharply. Major indexes break below their 200-day moving averages, or economic indicators such as rising unemployment and an inverted yield curve emerge. Before the 2008 financial crisis, for instance, the yield curve inverted in the late 2006, warning of an impending downturn. Once a bear market sets in, it's common to experience short-term recoveries known as bear market rallies. These temporary upswings in stock prices amid a broader downward trend often lure investors back in before the market resumes its decline. History provides many examples of such deceptive rallies. After the 1929 crash, the Dow Jones rebounded by 48% between November 29 and April 1930, only to plunge further, ultimately falling 86% by 1932. During the dot-com bust in 2000-2002, the Nasdaq experienced multiple rallies of over 30%, yet continued its downward spiral. The financial crisis of 2007-2009 saw several sharp rebounds, exceeding 10%, but the market did not truly recover until early 2009. These historical precedents highlight the dangers of assuming a quick recovery in bear markets. Investors who misinterpret bear market rallies as the start of a new bull market can suffer heavy losses. Strategies to navigate these periods include diversifying across various asset classes, investing in defensive sectors like consumer staples and utility, and utilizing hedging techniques such as options. To estimate how much the market might decline, investors often look at valuation metrics and credit spreads. The S&P 500 cyclically adjusted price to earnings CAPE ratio, for example, exceeded 30 in late 2021, a level seen only before major downturns such as those in 1929 and 2000. Widening credit spreads also signal increased risk and potential market instability, as seen before the 2008 financial crash. Currently, the valuation of the US stock market suggests significant overvaluation. As of March 1st, 2025, the CAPE ratio stands at approximately 34.93, substantially higher than the historical median of 16.04. This elevated ratio indicates that stock prices are considerably higher relative to their long-term average earnings, suggesting potential overvaluation. Historically, elevated CAPE ratio have often preceded periods of lower market returns, as valuations tend to revert to their long-term means over time. If the current CAPE ratio were to revert to its historical median, this would imply a significant market correction. Such a reversion could result in a substantial decline in stock prices, potentially aligning with past instances where overvaluation led to market downturns. The current bear market could be particularly severe due to the limited intervention option for central banks. Historically, institutions like the Federal Reserve and the Bank of Japan have cut interest rates to stimulate the economy and support stock prices during downturns. However, in a high inflation environment, they might be constrained from reducing rates without exacerbating inflation. This mirrors the 1970s and 1980s when high inflation limited monetary policy responses and prolonged economic downturns. The 1973-1974 bear market, triggered by an oil crisis, led to a stock market decline of over 48% as the Federal Reserve struggled to control inflation. Similarly, during the 1982 recession, inflation soared to double digit, forcing the Fed to raise rates sharply, contributing to a stock market decline of over 27%. Investor sentiment plays a crucial role in bear markets. Behavioral biases often lead to poor decision-making and significant losses. Recency bias causes investors to overemphasize recent market trends and assume they will continue, which can lead to underestimating the severity of downturns. During the 2007-2009 financial crisis, many investors believed each rally was the beginning of a recovery, only to see the market plunge further. Fear of missing out is another common pitfall where investors jump in during temporary rebounds, mistaking them for lasting recoveries. The buy the dip mentality, effective in bull markets, can be dangerous in bear market, as seen in early 2008 when investors who aggressively bought into declines suffered even steeper losses. Reflecting on past market downturns, a consistent pattern emerged. Those who mastered the courage to invest when sentiment is at its lowest often reap substantial rewards in the long run. One such lesson, as highlighted in the article, The Forgotten Lesson from Every Crash Since 1929, Be a Buyer When There Is No Hope Left in Markets, emphasizes the importance of strategic buying during periods of widespread pessimism. During the Great Depression, while many were fleeing the markets, astute investors recognized the opportunity to acquire quality assets at discounted prices. Similarly, in the aftermath of the 2008 financial crisis, individuals who invested amid the prevailing gloom witnessed significant gains as the market recovered. However, it's crucial to approach such strategies with caution. Blindly buying during downturns without thorough analysis can lead to unfavorable outcomes. A disciplined approach is necessary to avoid falling into psychological traps. Setting clear investment rules, maintaining a long-term perspective, and avoiding emotional trading can help investors navigate turbulent times with greater resilience. During a bear market, certain assets have historically provided safe havens. Treasury bills offer low-risk liquidity, making them a reliable option during economic turmoil. Gold, traditionally a store of value, has performed well during crises such as in the 1973-1974 bear market, when gold prices surged while stock collapsed. Counter-cyclical assets, including defensive stocks and commodities, can also help stabilize a portfolio. Cryptocurrencies like Bitcoin still present a more debated edge against market downturns. Some investors might view them as digital gold, but their relatively short history and volatility make their performance in prolonged bear market uncertain. However, increasing institutional adoption and regulatory clarity could support their resilience further downturn. Furthermore, the explicit support for the sector from the current Trump administration can potentially make the assets class counter-cyclical to some extent, reducing the historically high correlation with major indexes like the Nasdaq. Ultimately, understanding the characteristics of a bear market, recognizing the dangers of a bear market rallies, and maintaining a strategic approach to portfolio management can help weather challenging times. By diversifying holdings, being mindful of behavioral biases, and focusing on historically resilient assets, it is possible to navigate bear markets with greater confidence and preparedness, ultimately profiting from the environment and being positioned correctly when the overall trend eventually returns to bullish.